Emerging markets risk data. This is the China equity market over the past 16 years. Amazingly, we are looking at zero return in spite of the booming China economy. But suppose you had protected capital during the three big market drawdowns over this period. Well, then you would have scored a fabulous return, which just goes to show managing downside risk can generate huge rewards. All you need is an effective risk measure. Now, we learned the hard way that the standard measures of risk are just not up to the job. So we developed a systematic approach to risk that works through hundreds of algorithms. Now, the systems are complex, but the final delivery is crystal clear. High risk. There's a high probability of capital loss going forward. So we recommend zero exposure to the asset or market. Low risk. Well, now we're comfortable with 100% exposure. Money managers can use our risk data to develop any number of highly effective risk-based strategies, but they can also choose to just incorporate our risk data into their existing investment process. We're generating all of this data on a weekly basis across hundreds of assets and markets. It's a continuous stream of data. So just how effective is our risk data? Well, back to China for two quick examples. Now we're looking at the China stock market over the past 8 years, which is when we launched our systems. Notice these flat horizontal lines here. These are the periods of time when risk was high and we are therefore out of the market. We are cash, but when risk goes low, we re-engage back into the market to earn the market return. Here we see our systems operating at the level of a single stock. JD.com lost 28% of its value over this 13-month period. Our risk data delivered a 43% return. We are generating our risk data on every single emerging market and on 1,200 emerging market single stocks. It's basically the complete MSCI emerging markets universe. We're also using our risk data to deliver long-short market views on virtually every single commodity. It's definitely a paradox, but less risk in emerging markets will systematically generate a significantly higher return.